Would you like to know a way to pay for the fun things in life without having to get into any more debt? Wouldn't we all? Well, in today's video, we're going to be looking at the concept of a sinking fund, understanding what it is, what instruments to use for it, and what expenses go in there. Mitchell here from Study Wealth, documenting our journey to success, looking at videos on personal finance, entrepreneurship and financial education. I aim to educate but also learn on my journey to success. If you haven't done so already, please make sure to click the like button on this video and subscribe to my channel for regular weekly videos on helping you to achieve your journey to success. I came across the concept of a sinking fund in my revision class for my Wealth Masters this week. We were looking at how a company allocates a portion of their revenue towards an expected future outflow. This can be something like a bond, which a company uses to raise capital, to raise money for the firm. It has to pay it back at an expected point in the future, and so it allocates a portion of its income every month or every year to that expected outflow. That's exactly what I do in my short-term goal account, and it made me think about the individuals that use a sinking fund when compared to the likes of companies that use it for their expected outflows. If you're following the Study Wealth spreadsheet, this is allocating 10% of your net income to this category. It's called the short-term goal account, also be a reserve fund, holding fund, or sinking fund, and is part of the 30% wants category. Now, 10% varies depending on what type of expenses you put in there. So you're probably thinking, what actually is it and how can we use it? The simplest way I like to think of a sinking fund is to look at the quote, just a little bit can go a long way. This concept really holds true for a sinking fund. You are allocating a portion of your net income to an expected future outflow. You do so by putting money away every month prior to that expected future outflow, so that when you come to paying that expected future outflow, you have the money to do so, and you're avoiding the need for a high interest loan or, of course, a credit card debt. A good example to use, which will make the sort of concept of a sinking fund way clearer, is to look at car insurance. Car insurance, or any type of insurance, is a really good way to save in a sinking fund. You know from the previous year's price that your insurance, car insurance, will be around a certain figure. For the purpose of easy maths and for understanding the concept, let's say that my insurance was £2,000 this year, so I can expect it to be around £2,000 next year. Let's say that's due in 10 months' time, so we can allocate £200 a month in a sinking fund for that expense in 10 months' time. When it comes to our car insurance being due, you can search around, do what you need to do to save as much as possible, comparison sites, and then have the funds available to pay for that car insurance. This is combining a video here where we're looking at saving on car insurance with actually having the funds available and avoiding the need to get a loan from the car insurance company who would charge a high interest. You have the funds available from your sinking fund that you have allocated. It's a really good example to show how allocating a portion of your income into an account can really help you save, but also accumulate over a period of time. Prepare to allocate your expenses is key for creating sinking funds. You're probably thinking, what are the best instruments for this type of fund? Now, some people use cash, whereby they get their cash out, put it into an envelope, put a picture on top and draw how far they've come up to that. Now, we are Gen Z, we are millennials, we love our technology. So that's not necessarily the best method for us. We are the paperless future. So Monzo, other challenger banks that I'll link below, are really good for this type of expense or savings. It's really good for your sinking fund. You can allocate to different pots. You can set goals for those different pots, and it will show you what percentage of your goal you have achieved until you get to the point where you have to pay for it. What's even better if you've got it all within Monzo is that, let's say for example, I managed to get my insurance, like I actually did, for this time at a discount than what I expected. So let's say I get it for 1,800 rather than 2,000. I save £200 that I can then allocate to either another expense, or within that sinking fund Monzo Bank, you can then redistribute it into your other pots really easily. The reason why you're using sort of a cash savings account is because you need your money to be liquid, but you also want it to be low risk. So you can't really invest it into the financial markets, and you don't really want to put it into any sort of fixed deposit because you want the money to be available. It's not necessarily there to accumulate any interest, it's there to accumulate to pay off a future outflow. And so that's why you use the money markets, you use cash accounts for such an expense. Now I wanted to look at other examples, not financial examples, but I wanted to look at other examples of what you can allocate to a sinking fund. The first being a holiday. Now the average UK holiday is about £800 per person per year. So by saving about £80 a month for a year into a sinking fund, you're able to save that. Secondly, another good example is birthdays. You know for birthdays that you're going to be spending roughly X amount, so you can pro rata, as we say, that back towards the amount of months you've got left towards that birthday, and you can allocate towards a birthday fund. Finally, you're looking at other large expenses, such as pet bills. You may be looking at Christmas coming up. You may be looking at other insurances, pet insurance, car insurance. All of those sorts of things are expected future outflows. You know the estimated amount of it, so you can prorata that back and allocate it to your individual pots every month. It's a really good way to stop needing credit card debt for the wrong reasons. It gets into a really bad vicious cycle where you're constantly using debt for outflows and then spending the rest of that time paying it off plus interest. So this is a really good way to make sure that you are saving on that added cost. Finally, and again, please click the like button if you're getting value from this today. I really want you to not only understand this concept, but to go away and use it. I want to compare the difference between an emergency fund and a sinking fund. A sinking fund is allocating towards expected future outflows, whereas an emergency fund is an insurance premium for any emergencies. It is an insurance premium. It shouldn't be paying for your insurance. The less you need to dip into it, the less you need in that emergency fund. It should be kept for genuine emergencies, and you'll appreciate me saying that when you do get a genuine emergency. It may be that your car goes drastically wrong, such as it needs a new engine or 4 new tyres. It may be a family bereavement in another country and you need to pay for flights, hotels very suddenly. This is where you will thank me for keeping your emergency fund for emergencies and using a sinking fund to allocate towards future expected outflows. If companies do it, so should individuals with their salaries. So that's the end of today's video, understanding the concept of a sinking fund and how it works with Study Wealth's short-term goal account. I hope you've enjoyed today's video. Please press that like button if you've got value and subscribe to my channel. Comment below if you have any questions regarding the sinking fund topic. We've now covered the 50% needs category, the 30% wants category, and we're going to be moving on to looking at how savings and investments can be utilized for your future success. As we say on Study Wealth, we're documenting our journey to success. So I hope you're enjoying the videos, and by all means, please do get in touch if you have any questions or would like to have a call with me to discuss your specific finances. Thank you for watching.